Season 6, Episode 5, Roth and HSA Accounts, Certainty and Constraint. In the previous episode, we explored tax-deferred accounts. Those accounts change the timing of taxation. Income inside the account compounds without annual taxes. But eventually, when the money is withdrawn, the tax system takes its share. Taxes are postponed, not eliminated. But there is another type of container that works very differently. Instead of shifting taxes into the future, it settles them at the beginning. These are Roth accounts. A Roth account follows a simple structure. Money entering the account has already been taxed. There is no upfront tax deduction. You contribute after-tax dollars. But once the money is inside the account, something unusual happens. Dividends accumulate. Interest accumulates. Capital gains accumulate. And under the rules of the account, those gains may never be taxed again. The tax system has already taken its share. So the compounding that happens inside the container is effectively invisible to future taxation. This creates a different kind of certainty. With tax-deferred accounts, taxes arrive later. With Roth accounts, taxes are settled now. The future compounding belongs entirely to the investor. That is the defining feature of the Roth structure. Taxes first. Growth later. But certainty rarely comes without conditions. Like other tax-advantaged accounts, Roth accounts come with constraints. There are limits on how much can be contributed. There may be income restrictions. Withdrawals of earnings typically require waiting until certain conditions are met. These rules exist because the tax benefit is substantial. Once money enters the Roth structure and the rules are followed, the growth may remain permanently outside the reach of future taxation. And that level of certainty requires guardrails. Now let's look at a container that is even more unusual. The Health Savings Account, or HSA. At first glance, the HSA appears to be designed for a very specific purpose: healthcare expenses. But structurally, it has one of the most powerful tax profiles available. Because the HSA combines three separate advantages. First, contributions are typically tax-deductible. Second, investments inside the account grow without annual taxation. And third, withdrawals used for qualified medical expenses are not taxed. Taxes are avoided on the way in, during growth, and on the way out, provided the funds are used according to the rules. This combination is sometimes described as triple tax advantage. Few financial structures offer that alignment. But again, the structure introduces constraints. HSA contributions are limited. Eligibility is tied to specific types of health insurance plans. And withdrawals are expected to be used for medical expenses if the full tax advantage is to be preserved. The container is powerful, but it is specialized. When viewed together, Roth accounts and HSAs introduce something different into the architecture of a financial system. They introduce certainty. Tax-deferred accounts postpone the tax decision. Taxable accounts trigger taxes as events occur. But Roth and HSA structures resolve taxation in advance or eliminate it under specific conditions. Once the rules are satisfied, the future tax environment matters much less. The compounding engine runs without interruption. This difference in certainty can play an important role in a diversified financial system. Some capital may live in taxable accounts, where flexibility is highest. Some may live in tax-deferred accounts, where taxation is postponed. And some may live in Roth or HSA structures, where the tax outcome is already known. Each container changes the balance between flexibility, timing, and certainty. And that leads to the next important question. Once we understand how each container behaves, how should investments be placed inside them? Because not all types of investment income behave the same way. Some produce frequent taxable events. Others generate gains only when assets are sold. And once you see those differences clearly, a new layer of financial architecture begins to emerge. The idea of matching income types to account types.